What's going on, guys? This is episode 5 of the snowball experiment, in which I invest a small amount every single week into some covered call ETFs or dividend stocks, depending on how I'm feeling, in order to demonstrate the power of compounding and explain also my thought process while investing. This has been a turbulent market, to say the least, especially in the crypto market, where we have had a distribution pattern here, and we broke that neckline and have been puking since. So in just a couple months, Bitcoin has lost 30 something thousand dollars of value. So is this an opportunity? Is it not? I'll discuss my opinion on this later on in the video. But this is why you need to be diversified, in my opinion, if you're going to build some type of income engine, because you don't want to have all your money tied into a single sector or stock, especially a volatile asset like crypto. This is why today we're going to take a look at a few ETFs that I've been researching a little bit in the past week or so. That are about covered calls. I'm no expert in covered calls because I just started this process of investing in them. I've always been a bit more old school in investing into lower yield companies and that grow their dividends over time. But I'm always willing to learn something new. And I think that this snowball experiment is one way that I can use in order to try to explain my thought process as I learn a new sector or a new area of the stock market. So up here we have a few dividend covered call ETFs. This is HDIV. It's Hamilton dividend ETF that is composed of many different other ETFs for diversification purpose. I find that it has a pretty good dividend, around 10%. What I like about it is that it keeps growing its net asset value so far, and it has a bit more data than a lot of the newer ones that are 3 months old. So I can tell a little bit how it behaves depending on the market conditions. This one, HUTE, on the Toronto Stock Exchange, is about utilities. Base is about base minerals and metals and things like that, companies in that area. We have gold over here, and we have oil, and we have BMO technology fund. And what I want to show you here is that two of them have performed admirably in the past few years. One of them is gold, which has done over 209%. This is the gold ETF that I found that had the best overall performance. This is including the dividends or distributions, I should say, of the covered calls. And then next to it is ZWT, which has performed really well. For instance, if we compare it to the S&P, and over here, the S&P has done 76% over the same period, and these, even though they provide some source of income, have been beating the market to a pulp. This is what I like to see. Over here, we have in the third place, we have HDIV with 84%, and then we have the utilities one, and then oil, base metals, and minerals. So this is good diversification in the sense that if you take a look here at the 1 year, you can see that most of the results of the past year have been driven by gold with 94%, while the other ones were kind of lagging behind, even though 21% over a year is very, very good. This one would have brought complete results to a better ending. And if you take a look here at 3 years, then you can tell that in this period here, the clear winner was technology. So now in that zone, technology was the one that was dragging the other laggers. Some of them were even in the negative for that period, at least in the beginning. So you would have been able to sustain your NAV in that time period. And what I want to really show in this example of diversification is that over 5 years, however, oil was the one that was dragging the entire portfolio if we started from that zone. So let's say I zoom in over here, gold, which was the clear winner, here is the clear loser. So it's difficult to try to predict which one will win over a certain period of time. So I think when it comes to investing, especially if you're a long-term holder and you want to create wealth over time and not spend too much time in front of the computer analyzing stocks and ETFs, then this is a very good way to go about it, to just find a few ETFs that represent a few sectors and then invest in those as you see fit in a more or less equal manner. And then eventually the winners will appear by themselves, and then you just ride the wave. And what I do is I tend to buy the ones that have been performing the least over a certain period. If I know that it's a good sector, a cyclical sector especially, that might have a chance to recover based on macro factors. So this is a little bit what I wanted to discuss, is that you can find 5, 6, 7, 8 of these covered call ETFs that represent a niche, and then start spreading money. What I've been doing with the snowball experiment is I've just been throwing stuff at the wall and see what sticks, and try to start to get a feel for these covered calls. And then as some of them will retract, I will start to see if that's an opportunity or not. And right now, it's been the crypto ones that have been beaten quite badly. So I'll probably cost average into those because I don't have any time horizon, any need for the money in the short term. So I can afford to put some small amounts into it and just increase my position. And then when the market picks up again and starts to go up, then I will profit from having been patient. As far as what I've invested in this week, you can see here that the one that's been performing the least has been oil in the past year. And I chose ENCL, which is pretty much the same as ENCC, but with a little bit of leverage, 25% leverage, I believe. And this will give me a bit more of a yield. Correct me if I'm wrong, but I think the yield was 16%. So let's take a look. 16.35% yield, which is not too bad. And now my yield for the experiment is at 21%. I think this is a bit skewed though, because I have a hard time believing GDXI will stay at 70% yield. I have a hard time believing that, but we'll see. Maybe I'll see some nav erosion or something, or maybe the data is skewed. But nevertheless, over here, we can see ENCL here. I've invested just $300, and it should give me $49 of annual payouts. And since we're on the topic of diversification, this is something else that I want to mention, is that if you are to invest into dividend ETFs or stocks in order to create income, what I like to do is try to equalize a little bit the amounts that each generates, so that I don't have one that gives me $400, and then if the dividend gets cut to zero, I'm down to 600 instead of 1,000, for instance. So what I'll do in future weeks or months, I'll try to add to the positions that I have over here, so that I reach, let's say, as an example here, maybe $100. I could go for SLJY, which is close to the goal. Biggie is close to that goal. Canny, I put another $300 and I would be up to the 100. ENCL, maybe $400, and then it would generate another just enough to get $100 yearly. And I would do that across the board until I have some type of diversification of income, not just diversification in terms of sectors, but I would try to equalize the contributions that each holding I have make in my income portfolio. To close out on diversification, another thing I want to mention is that what I will do with these is I'll try to build at least 20 different positions, maybe close to 25, 30 ideally, and try to move these percentages closer to 5% maximum in each of the investments that I will make. And the goal is just to solidify my sources of income so that I'm not, if something really big happens to a company or any type of sector, then I will not be hurt too much. But I need to mention that in the current state of the market, I'm a bit nervous about the technology sector and I'm expecting a pullback, although I still have some tech stocks like Google and Microsoft and Apple and Amazon and things like that. But I've been investing very heavily into my other accounts into consumer staples and materials especially, and I'm just starting to build positions into energy stocks, Chevron, Oxy, Enbridge, all these major players, Exxon, just because I believe that this is where value is. And as far as consumer staples, I've been investing heavily into food. Um, some stocks come to mind like Hormel, Campbell, General Mills, other staples like Clorox have been beat down like crazy, and I think there's true value in those. These are lower yield dividend stocks that I'm not going to talk too much about on this series because I'm trying to make it more about covered calls, even though I'll buy a few stocks. But what I want to do in phase one is to build a big base of covered call ETFs so that have high yields. And then as I go along and create more income coming in on top of the amounts that I will be putting in every week, I will start to build positions into high yielding dividend stocks specifically that I think will control the NAV erosion of the covered calls that might happen, especially if there's a downturn and the market drops, let's say 30, 40, 50%. Covered calls, because of their nature, because they are options, they will tend to not follow the market because the covered calls will get basically triggered, so it will not go up at the same time as the market, and this will create NAV erosion over time. So because of that, I want to have some type of exposure to alpha in case of a market drop, and I will do that in time with my regular stocks, and this will help me control the NAV erosion. It will lower my yield, my total yield, but right now I'm around 21%, and I think about 10% would be something to shoot for in this experiment. So that about covers what I wanted to say about diversification in this video. In the next video, I will go over my crypto strategy and I will explain the vehicles that I will be using in order to profit from this downturn. So stick around.